What's up, everyone, and welcome to a special edition of the Daily Macro Update for Wednesday, January 28th. It is Fed Day for the first Fed meeting of 2026, and we're going to go ahead and get into the live stream here of the actual Fed meeting where Jerome Powell is going to get on stage and give his press release speech. Typically, during that time is where you have the market fluctuations with the reaction from what he is saying, as well as answering the questions. And so we'll be looking at that and translating a lot of the bank language that he uses. We have to keep in mind that the Federal Reserve is really an evil entity, even though the people that may be working for the Fed aren't evil themselves. But this creation of usury, right, charging interest for money that they create out of thin air is what causes inflation. This is why we have to invest our money to protect our capital from being depreciated. So we'll go ahead and get into all that stuff. Just a reminder, if you guys are new to the channel, go ahead and subscribe, as well as share this with a friend. This is Macro Optics. We like to go ahead and take an unbiased view of the markets and use math as well as our indicators in order to guide us to own bullish trends and avoid bearish trends. It's a lot easier said than done, but just like anything, when things are simple, they're hard to enact, but that's what we do here. All right, let's go ahead. I will share my screen here. Let me know if you guys can see this. All right, taking a look at the press release that was just released a little bit ago, we can see that they are maintaining the hawkish pause here. So as we know, taking a look at the Fed Fund futures, there was at least a 98% chance that the Fed was going to pause here. So this pause isn't something that's surprising. The market was already pricing this in. But when taking a look at the statement here, it is interesting to see how there's a big surprise in language for accelerating growth. So just looking at the statement here, they officially upgraded economic growth from moderate to solid and crucially removed the warning about rising downside risks to unemployment. So they effectively are declaring that the employment situation has stabilized. And this confirms our team's Goldilocks thesis, meaning that the economy is reaccelerating, and that's being supported by the quiet liquidity injection that the Fed is doing right now in order to stabilize liquidity conditions. A lot of people are thinking that this is quantitative easing, but it's not. It's maintaining ample liquidity levels, right? The way that I like to view this is, say the entire liquidity in the markets is like a bathtub. And like during COVID, all that liquidity was drained, right? And so they had to come in and essentially take like a bunch of 5-gallon buckets and quickly refill the water level. Well, what happened here post COVID, all that money, all that bath water was like overflowing. And since 2020, it's been steadily declining, but it's at a level now where they can't let it go any farther down. And so they're just putting in small cups of water to maintain that level. It's not the same thing, although they are buying treasury securities in the open market. But just know that there's a difference between the classic QE that people think of versus the stabilization that they're doing right now. This is called reserve management purchases that started last month. And so this new stance implies that the bar for future rate cuts is now much higher, pushing anyone positioning for a recession to be positioned wrongly. And consequently, myself and my team are fading the momentum in defensive assets like utilities as well as healthcare, and rotating aggressively in things like housing, energy, as well as real assets like gold, silver, all those things that have been on the news. If you go back and watch our videos a few months ago, we've been getting long a lot of these different things like silver, platinum, palladium, all of these hard assets. And ultimately, this has been not predicted, but shown in the yield curve. So one of the things that my team and I like to look at is the United States yield curve. And when we see it here, the current trend, this is an indicator that my team and I have created here. Let me know if you guys can see this. But hold on one second. Okay. Yeah, and so right now we are doing this bear steepening, but it's a bear steepening twist, right? And so when taking a look at our twist signals, what this essentially is showing is that the market is losing faith in what the Fed is able to do, right? So Their actions are technically dovish and reluctant to hike, but a lot of the market participants are saying, we don't trust the Fed anymore. It's time to go into hard assets, and that's what the yield curve is signaling. Because normally during a bear steepening, that is more of a growth signal. But this bear steepening twist, which again, it's when yields move in the opposite directions. The long end of the curve goes higher, where the short end of the curve goes lower, and that is not normal, right? Normally, yields move in parallel, not in anti-parallel. So we have to look at this situation as something that's rare and ultimately a market signal. And so this large rise in the 10-year US government bond yield, which I can go up and find right here, this acts as a valuation wrecking ball for high duration assets like crypto, tech, as well as long bonds. And so this is why, things like gold, energy, silver, other types of industrial metals have been doing really well. It's in order to hedge against a bond market that is tightening financial conditions for the Fed, right? Because the Fed has essentially given in to the government by saying, you know what, we've been cutting rates in order to try and lower interest rates, but the bond market is saying, you guys should not be doing that. In fact, when we take a look at the bond market here, looking at the 10-year, ever since September 17th of last year in 2025, what has the bond market done? It has gone up, right? It's up nearly, what is that? 26 basis points, which I know that doesn't sound like much, but in bond terms, this is a multi-trillion-dollar market, right? The bond market is huge. It's way bigger than the stock market. So any type of, small rise in yields, that's a big deal. And so ever since they started cutting rates again for the second time back in September, rates have gone nowhere but up. So that is not, what is supposed to happen there, right? Anyway, we're going to get going here in about 8 minutes with the Fed meeting. But yeah, I mean, taking a look at what my team and I have been doing as well, continuing to buy things like gold on dips. I mean, gold is making another all-time high here. GLD is the ETF that we prefer, SLV for silver, as well as XLE for something like energy, right? All these things have been doing the best. Interestingly as well, Qs went back to bullish trend in our model. So now the SPY Qs as well as small caps all remain in bullish trend. Let me go ahead and change that in TradingView here. And it looks like there's a little bit of an opportunity here to re-enter into small caps. So I was looking at that here today. And then, yeah, most mega caps not looking too great, but we remain in this Goldilocks type of environment supported by a dollar that is also in a bearish trend here. So that was a pretty crazy move by the dollar over the past week. So all signals that could be interesting in the short term, and there's definitely going to be bull markets to take advantage of, but it's not in the bull markets that you would typically think, right? So don't just go long S&P 500, Nvidia, Tesla, and Bitcoin, right? This is something where you have to shift your long allocations. But before we get into that, we can take a look at any type of questions that you guys have before the meeting here starts in 5 minutes. Before we get into questions, just put a 1 in the chat if you guys can hear the we'll get the SPY going just to see what the market reaction is on the split screen feature. For the people on Instagram and okay, so YouTube, you guys can hear the piano playing. Great. Go ahead and mute that. But yeah, so I apologize for the content with the lack of content recently. I was on a trip and then we had a huge flight delay. I was supposed to get in on 5 p.m. on Monday, didn't get in until 3 a.m. on Tuesday morning. So that, as well as I've been a little bit sick, but I appreciate everyone's patience here. But I did want to try my best to get on here at least for the Fed meeting. So, but we will be back to the regularly scheduled content release from here. Did you see the crazy move in IDX today? No, let's take a look. Oops. Indonesia. Wow. Yeah, that's quite the drop there. I wasn't long IDX. I'm not sure if you were, but yeah, that's quite the drop. Not sure what happened there. Dino asks, "Are you bullish on gold?" Yes. My physical holdings in gold and silver are up big. Would you rotate? What would you rotate into, and when to take profits? Yeah, I mean, like I mentioned before, I mean, energy as well as housing are some things that are looking pretty good. Something like XHB, right? Having a little bit of a dip here near the low of the trading range. Are you still bullish on gold? Yes. Any thoughts on Dell coming back? I'm not sure. I haven't looked at Dell. Constellation Energy, a good buy. What's the ticker for that? Let's see. Oh, CEG. Oops. No, CEG is in bearish trend, so that would not be one that would be on our team's list to buy. When something breaks trend like that, just don't even look at it, or don't even look at buying it because it has a very high risk of continuing to go lower. I'm long CVX. Yep, Chevron. Exxon is a better one, but yeah, I mean Chevron has been having a huge move as well. I did see that the last couple days. Yep. So we'll see what happens here with the markets. CES. Do you mean CS? I'm not sure what ticker that is. Will the Fed bail Bank of Japan with the yen intervention? Maybe a possible Plaza Accords 2.0? Maybe. Can you look at quadruple U? Sure. Let's see. Energy fuels. Interesting. Yeah, I'm not really sure what this company is, but it's in bullish trend for sure. Would I be buying it here? No. It's right at the top of the trading range. So, all right, it's going to start here in a couple minutes. Yeah, and just so you guys are aware, if you guys are looking to take a lot of this macro knowledge and incorporate that into your trading process, whether you're someone who just looks at fundamentals or just looks at technicals or maybe both, in this post-pandemic environment, you have to incorporate macroeconomics into your process. It's the way to stay ahead. So if you guys don't already have a group or something that you're a part of, feel free to check out our stuff here at macro-optics.com. You can go to the memberships just to see which ones we have. We have one that's $15 a month. You get a 1-week report as well as access to our Sunday macro wrap up. We send you that report that includes the 25 top ETFs and top 10 stock picks, what their trends are, what their ranges are. And then also, too, you get access to our community where you get the 8-chapter advanced macro training that's there. Check that out. If you're someone who has more than $50,000 in your portfolio who is looking to actively manage it better, we have our partnership circle, which is more of like an active help type of group, and you get access to a lot of our different picks as well as all of our other resources too, and a user license to our trading range model on TradingView, along with a bunch of other ones that we used in order to execute on our process there. So. But a little bit of a plug. Always got to do that. Looks like the meeting is about to start here. So let's go ahead, and I will shut up, and we'll begin.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Pretty standard.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political Can you say why you attended and what you would say?
Trash
in response to
question.
the Secretary's criticism.
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas. But I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Another trash question.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No. And I really, once again, have nothing for you on that.
Still
today.
no questions yet about them buying bills.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer.
Why are all
we've
these
seen
people
quite
like
big movements
asking
in the
these
dollar
questions
over
right
recent
now?
days? What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But, what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy, and some
Which
other
prints
things, but
dollars.
We don't comment on the dollar. Sorry.
You guys see that?
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. I mean, maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course, no one knows with any precision. So, if you had a follow up,
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization, but at the same time, we've done a lot of the process of normalizing. A good piece of it.
Whenever they
is
say
done with 75
normalizing,
basis
that means
points,
rate
and
cuts.
Before that, 100. It's 175 basis
Bank
points
language.
we've cut since we began cutting in September of 2024. So you've moved now to 3 point. The Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Thank you, Chair Powell. Amira Mokwe from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the two goals and how big those and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
Silver up 8% today. It's wild.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2% x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of
Talking
election.
about
They
this right
spiked
here,
around liberation,
which it has gone up.
and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
He didn't even answer that question. Ever since the beginning of the year, it's gone up.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think that the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now. Anybody's base case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of
good
turmoil
question.
recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Best question
Over
so far.
time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment. And so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with. And that, in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not what Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Which is true, but that lady just
Thanks so
pointed
much,
something
Elizabeth
out
Schulze
that
with
bond
ABC
market
News.
has been
Republican
calling
Senator
them
Tom
out.
Tillis, who sits on
They
the
shouldn't
Senate
be
Banking
cutting.
Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the US context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important. And the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes.
Complete lie.
I'm strongly committed to that, and so are my colleagues.
They're committed to it. But that's not what they're doing.
Archie Hall from The Economist.
Jeez.
On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the Beautiful Bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially, the economy has once again surprised us with its strength, not for the first time. Consumer spending, although it's uneven across income categories.
Surprising because it's mostly being uplifted by the insane amount of government spending going on, which he touched on, that was on an unsustainable path. But that's a direct injection into
growth is
consumption.
on solid footing, it looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for
Assets
some
have been
time
going
now,
up in
for,
value.
a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control and, frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs? And how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time is rising productivity. So and we always ask, well, this is going to be different. Is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Beyi.
Thank you, Chair Powell. Beyi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December. And that's pretty much what we had the year before. So on net, no progress. But the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs. And ultimately, we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period. And you can see for that tariff, how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that. And our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But, we'll be able to see whether things are moving in that direction. I think, we will be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is a lot of it is around energy, oil. And so far, we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate. And in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output. And it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. It was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Trash
Honestly,
question.
I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Another is that, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look
That's exactly what we said before this stream.
Our credibility is right where it needs to be. So we look at those things. We don't get spun up over
You see, they
particular
know.
asset price changes, although we do monitor them, of course.
They know.
For the last question.
Him even mentioning it is him. You got to read between the lines
Hi,
there.
Nicole Goodkind Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward looking, but should be more forward looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision making? And do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense. And I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections. And that's the basis for how we think about the economy. So the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model. And we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution like happened in the 90s here and like maybe happening now with AI, we're all over that. And, everyone studies those periods and, we're very clear-eyed about the possibility that this higher productivity may persist and also that it may not. We're not, no one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time?
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything. And so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
All right. So really the main takeaways, and there's only like a couple of good questions. I hate how it takes like an hour to go through the majority of them, really terrible questions. But the key takeaways for what I saw was that, he's not in any type of rush to make any type of rate cuts from here. And you kind of had to read between the lines that he understands that, growth is continuing to show signs of accelerating due to the, unprecedented amount of spending from the government. But also, too, when a couple of people noted the acceleration in oil prices, as well as the acceleration in 5-year break-evens, that he essentially dismissed those, which is them essentially making a inflation is transitory call, which is exactly what they did in, in 2021 before inflation got out of control in 2022. So I don't think that inflation is going to go on a run streak where it's going to go back to 2022 levels around like that 6 to 9%. But I think it's going to remain sticky here around this 2.5 to 3% move. And that's really what the indication has been from the 5-year break-evens, as well as more recently. So you can see here how the 5-year break-even inflation rate, which this is the bond market's way of trying to price in. It's basically the bond market's guess of the average inflation rate over the next 5 years. And so you can look at this chart as almost like a real-time indicator of inflation by the bond market. And so what's interesting is that, ever since the pandemic here, this is going all the way back to 2019, what has the break-even inflation rate done? It's essentially come down to 2.471% and has hung out here. And that it came back down to that, in September of 2022. And then if you go back further, the average break-even inflation rate wasn't at all this way in, post 2008. It was hovering around here around let's see, what is that? 2004 through 2008. And so, the break evens can remain here for quite some time, but this is way higher than the post 2008 great financial crisis. And so they are looking at this, but he completely dismissed the rise in this as well as oil prices. So, I think that might be coming back to bite him after this, but he's sticking to his guns, saying that inflation is a one-time shock from the Trump tariffs. And so, it's yet again Powell blaming Trump. Trump is always blaming Powell. They're always just pointing fingers at each other. And so we're not really going to get to more of clear answers from the Fed until we have more of the real data coming out, which should be around the March meeting. Due to the government shutdown, we're really not working with clear numbers in terms of the real data. But just looking at the pricing charts as well as the moves that we've seen in silver and other precious metals, I mean, this is typically a sign that inflation is going to remain sticky, right? And it was funny how he didn't comment on these things, saying that they have no macroeconomic relation, which is completely false. So I think there was like 3 or 4 times where he blatantly just lied to the American people. So it's like he's not in favor of they're not really trying to help us out, right? So, but those were really the key takeaways here. And so yeah, we can go ahead and conclude the live stream there. If you guys have any questions for our team, especially those who are inside the community here, you can go ahead and ask those in the group, or you can, send us a DM. If you want access to our community, you can go ahead and take a look at our website there on macro-optics.com, and you can read, the differences between the two offers there. But I appreciate everyone for joining. And good luck out there. We will catch you in tomorrow's daily macro update. Bye, everyone.